This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City on the evening of April 29th. Well, our theme has been that inflation is running out of control, and today's gross domestic product numbers for the first quarter gave analysts something of a shock. They had been expecting inflation on a GDP basis of 2.3%, but it came in at 4.1%. That's one of the highest quarterly inflation rates in the past 40 years, and relative to the long-term declining trend of inflation, it's the biggest jump in inflation on a quarterly basis that we've seen ever. There are many sources of this. We've pointed to them. One is the fact that the entire American population is speculating in houses as an inflation hedge. Another is the breakdown of supply chains across the board. That's true of oil, where despite high energy prices, the rig count in the United States is the lowest in 20 years. That's because the Biden administration's policy towards oil drilling is outright hostile, and investors aren't putting money into oil despite the profits to be made there. Then you have the global semiconductor shortage, which has played havoc with auto production. Ford Motor Company was down 10% today, the worst performer on the S&P 100. So what's going to happen as a result? Well, inflation is going up. The value of bond coupon payments is falling. What this means is simply that bond yields have got to go higher, and the dollar has got to get cheaper in order to persuade the world to buy American treasuries. And America has to sell treasuries. The American budget deficit is up in the $3 to $4 trillion range. So if you look at the chart, you can see that during the past few years, there's been a sharp drop in foreign holdings of U.S. treasuries. In fact, a decline of about 10%, which is pretty remarkable. That decline has been most pronounced when the dollar got expensive. The world likes to buy dollar bonds when they're cheap, not when the dollar is rich. So we've seen both the dollar fall and bond yields rise during the last couple of weeks, and I think that's the beginning of a trend. So you don't want to own the US dollar, you don't want to own US bonds. The kind of stocks to hold: Chinese market after the first quarter shakeout in response to the leveraging looks well valued. There are some very good European companies out there which will benefit from China's expansion, as well as alternative fuels. Siemens would be the top of my list. And there's some American stocks which can ride out the inflation wave relatively well. For example, the large banks, which make more money when the yield curve steepens. So I think the main theme to keep in mind is that fear is going to replace greed as the motivator of markets. It's a time to try to protect capital and to be afraid, to be very afraid. This is David Goldman, Asia Times Deputy Editor.